Hi, and welcome to Jankinsgaard on Risk, the YouTube channel dedicated to the theory and practice of risk management. In this video, I'm going to talk about risk budgeting, which I consider to be the next step in the risk management evolution. It allows us to move beyond some of the limitations of the traditional enterprise risk management approach. And for more on risk budgeting, please consult my book, Empowered Enterprise Risk Management, co-authored with Petter Kapstad. There's also more information on my webpage, riskbudgeting.se, and as they say here on YouTube, please like and subscribe. So risk budgeting is about managing the risk of the firm as a whole. It's not about some narrow definition of performance or one or two risk factors individually. It's about the risk and return profile of the entire firm. So it's a bigger picture kind of view on risk. A core purpose of risk budgeting is also to provide an understanding of how well capitalized the firm is to resist prolonged falls in revenue. So it's the old idea of having financial resources as a buffer against risk. So it's we want to formalize these ideas and incorporate them into our decision making. So we're going to make a point here of the fact that corporate policies, the executive's own actions, are often what drive the firm's risk and return profile. I mean, a lot of these risk management programs focus on things that could go wrong, like external factors influencing the firm. But a lot of times it is the very policies that managers implement that in a big and meaningful way can affect the risk and return profile. And I'm talking about things like capital expenditure, investment program, acquisition, dividend policy, borrowing, hedging. All of these are major determinants of the risk profile. And if you change the policy in regards to any of these, it's going to have a significant effect on risk. So it's an inescapable conclusion here that one of the biggest drivers of risk are the very strategic decisions that the executive team implements. So, and therefore, what we would like then is some kind of a forward-looking analysis. We want to be proactive about this so that we can show beforehand, before we commit to a course of action, we can show the risk-return profile as it will look, depending on which strategic decision or policy is implemented. So it's the before and after kind of evaluation, the proactive aspect of this for a number of potential evaluated policies. So we're still at the point where we are trying to figure out what is the value maximizing policy going forward, right? We want to investigate some of the consequences on the risk profile from these policies, right? So before decisions get made, we're proactive as opposed to reactive. And what we come up against, one of the conclusions you end up having to draw is that the risk register, that this is the workhorse, the bread and butter of enterprise risk management programs, is very limited in this regard. And you might think it weren't because after all, you put together all these different risks into there. It's supposed to be all the major known risks that the company is facing. So it's very ambitious and very broad in scope, but yet it fails to add up to any sort of meaningful indicator of performance risk, because it's ultimately only a static compilation of risk. It's a snapshot of what we're seeing right now. We're listing more or less some of the risks that matter, which can be a very useful exercise, good for risk governance and get the attention where it needs to be and get dialogues going. So it's all, it can be very valuable for sure, but it doesn't inform us about the risk of the firm as a whole. And as I've discussed in other videos, we can't really modify the risk register successfully either for this purpose. So it's not really designed for that. It's designed for other uses. And we need for this, for risk budgeting, we need an entirely different approach. And that approach is going to be a financial one. We're going to realize that to describe risk and return for the company as a whole, there's really no way around the fact that this can only be expressed in terms of financial numbers. these cash flows and earnings, cash balances, various financial ratios and so forth. These are numbers that managers use to run the firm, and they follow them over time, and they have certain targets for them. So they are very important. So it's not going to be very difficult to find ways to express risk using these numbers. It's quite likely to resonate with managers, and many times are already doing something along those lines. So we're just going to do that with a little bit more rigor and add some layers of risk analysis. So at the core of this risk budgeting then is a decision support tool showing forecasted financials, plus an overlay of risk analysis. We sort of, on top of that, we put some structure that lets us carry out risk analysis and provide this understanding of the risk and return profile of the firm. And such a model has a number of characteristics. One is that it's got perfect accounting integrity. So we're trying to be IFRS consistent, more or less, with the model, and depicting the firm as it will look in any scenario, reflecting these actual accounting principles. So we just set it up in the model in such a way that it self-balances according to these principles. So that gives you a lot of faith in the model's outputs. You can start to think of it as a reliable companion for decision making. It also has a substantial analytical integrity. And this is where, you instruct the model, how the various lines in it will respond to, let's say, a change in revenue. For a risk analysis to be meaningful, you have to have sound assumptions in place that, when revenue drops, say 30%, what is going to happen to the cost structure of the firm? We have some variable costs and some fixed costs. So we have to figure out exactly what is a reasonable response to assume there on costs. And a number of these analytical adjustments that make the model more realistic, because dynamics, after all, are super important in risk analysis, and we need to equip the model with the right dynamics. So that is what analytical integrity is about. And we also incorporate various risk exposures, what we know about risk, into the model. So we risk adjust them, basically. And the risk register, to some extent, can help us do that, but they're not equivalent, or it's not a simple step, but definitely. But we also need other ways to incorporate our knowledge about risk into the financial forecast. So we do that. We also add risk measures, and these measures are indicators of the level of risk in the firm. So if you have a number of risk measures, you can describe the risk profile. Like, this is the risk inherent in the current, with the current configuration of the firm's policies and operating activities, etc. You equip the model also with scenario capabilities to run any sort of scenario for your major risk factors. Maybe even consider implementing simulation capabilities, and you can take it one step further and start simulating outcomes. And very importantly, then, there's a user interface that lets you choose between different courses of action, different cases that you have prepared. Like, let's implement these policies. Maybe it could be a debt finance acquisition or major hedging policy. You design policy options, the available alternative courses of action, and then you sort of choose between them to learn from the model. It will provide feedback on the new risk return profile if you were to implement that policy. So that is an important thing. All right, so you set up the model along these lines. You have the net income statement, the cash flow statement, balance sheet, and you derive financial ratios from these. And these are fully integrated. They hang together with maximum accounting integrity and analytical integrity. And you then impose the risk analysis structure onto that, so that you incorporate the exposure information and you add some risk measures, and it's now a risk adjusted model capable of dealing with the risk of the firm as a whole. And in this structure for risk analysis, we think of risk in terms of breaches of critical thresholds of performance. So for example, here, loan covenants, it would be normally a very bad thing if we end up breaching one of these loan covenants, because the bank would impose possibly some limitations on how we do things, and we may be forced to issue equity. Many possible negative consequences from that. So you don't want to reach that. That's a critical threshold, that level, because in the loan agreement you find what these covenants are, so you can write that into the model. Cash commitment is another example of a critical threshold. You have a certain demand for liquidity going forward. You need to implement investment programs, and you need to take care of debt obligations, etc. So you need liquidity for various reasons, right? So if you put those together, that would be cash commitment. So you don't want to risk falling below that level, or too far below, so that your financial resources are inadequate to cover them. So just two examples here of critical threshold. They make risk analysis much more meaningful and more closely aligned to the value creation process of the fund. Because the point we're going to make now is that not meeting these commitments, these threshold levels of performance, they imply a disruption to the value creation process. So that you may find yourself forced to cut costs in a very panicky way, that you're desperate to survive, so you cut costs in a way that is not really optimal in the long term. So you pay for that in terms of long-term competitiveness. You may be forced to underinvest if you don't have the funds to secure, the level needed for the investment program. You may not be able then to service that, and that could put you in all sorts of trouble and imply negative consequences for your ability to compete. So in various ways, not being able to meet these thresholds are going to be negative from the point of view of executing your strategy optimally. So that's the thinking here in risk budgeting. That's how we frame risk. And we have a so-called distance to threshold analysis for that, so that we are always looking and evaluating how close are we to these thresholds, and policies can move us further away or closer to these thresholds. And scenarios, you need scenario capabilities for that. So you set the model up so that it's capable of running any number of scenarios then for multiple risk factors. So you translate the whole thing into model assumptions, like if this scenario happens, what would be the values for your risk factors that you sort of send through your model. Simulations are, that's the next level sort of thing where you can automate the whole thing. It's an automated scenario analysis, if you will, where you can run, let's say, 10,000 simulations, 10,000 scenarios. It should be. So it's very powerful. You can then do probability of type analysis, like quantitative risk measures. But simulations are optional. You can execute and do very well here with risk budgeting without that. But it opens up a whole range of new analysis. And here's an example of how you would set up a forecast initially. Revenue, cost of sales, and so on, all the way down to EBIT. In this case, we simplify and just put two numbers in there, the revenue and the cost of sales. But you add some risk information. Let's say somebody in the firm has thought about it and they've done a risk register of sorts and come up with probability and impact numbers. So that if there's a rainy summer here, we're taking the example of an ice cream vendor, let's say, and then so rainy summer is going to be bad for revenue. If it rains too much, nobody's going to come to the beach, and so on. On the cost of sales side, you have milk price uncertainty, just to take something, right? So meaning your input factors could be more expensive than you initially thought, so creating another deviation from the forecast numbers. You take that and instruct the model to incorporate them into your budget. So you move from the traditional one, which is just a static pinpoint, forecast, and you get risk-adjusted numbers that incorporate this knowledge we have about risk. In this case, the revenue is, there's more downside risk than there's upside potential, so you get a lower risk-adjusted number. So this is still what we think is the most likely scenario, but there are possible deviations from that on the downside and some on the upside. And in this case, the downside scenario sort of dominates. There's more downside. And same thing here on cost of sales. There's more risk of bad or negative deviation, so that the risk-adjusted number is somewhat higher here. So all in all, the risk-adjusted EBIT is significantly less than the reported budgeted number. So this tells us that, okay, we probably have to watch out here and pay some attention to that. And if you then want to simulate, you can do so. You have the information for that. So here we're simulating revenue based on the information provided about this, the level of risk involved there. And here also we take from the risk register, in this case, the potential outcomes for cost of sales weighted by the respective probabilities. And then you put those together and you simulate gross profit. So now you have a whole distribution here reflecting the inherent risk in cost of sales and revenue. All right, so now you have forecasted financials and you have a set of, a structure for risk. You have risk adjusted the numbers and set it up so you can even simulate. What you want to do next is to then integrate into your model these different strategic policies that you're about to evaluate. So you need an interface for that. And let's take then a large debt financed acquisition. You want to know, before you're launching the firm into that adventure, you're going to want to know what would it do to risk. And so why not then view this acquisition as a case and the debt financing that goes with it and attach it to the model. And we'll see then how that changed the risk profile of the firm. So here's a baseline risk analysis. You have put the model here in risk adjusted mode, meaning that you're using the information about risk exposures that you have. And you're simulating around a set of current market prices, so that around that you simulate prices. And you have then some model outputs here describing the financial situation of the firm, the financial forecast. So it's a baseline risk profile here, because you have some measures of risk down here indicating to you the current level of risk given at the as is, on the current policies. So if FFO, funds from operations, to that is a key measure of yours, and you have identified a target level where you want to be, you don't want to go below that for various reasons. There's a critical level when things would start to get tight and unpleasant and you're approaching a situation where you're in some dire straits. There's also a distress level, which would be really bad, connected to various consequences, implying panicky actions that you really don't want to undertake. So these capture your risk profile then. There's a certain probabilities here, 8 to 0, respectively. They increase over time. So that's a baseline risk profile. We can then attach a case. We're acquiring Apple Pie Incorporated here. So we choose here to activate it. And all that information kicks in because we have defined the case before and what that would involve. And that sort of feeds into the model, and you now have a new risk profile. So yeah, first the activation of the case and then the consequences of that. I mean, there are consequences on the financials everywhere, of course, but we're going to take an interest mostly in risk. So here we see that this debt finance acquisition would imply a much larger risk of not reaching the target level, critical level, and the distress level. So now you're seeing some significant downside risk here. And that's something for you to ponder on, like, okay, this is now the model is telling us that we are going to run some risk here if we go for this. And is it still fine? Are we going to accept this? Is the value creation such that we still believe in this? Is it going to be the right policy for us? So now you can make an informed, proactive decision about risk and return, as opposed to just plunging into the whole thing and hoping for the best. And once you have a model like this in place with the accounting and analytical integrity, it's a reliable tool to use for decision support across any scenario. It will indicate what the company would look like regardless of what you assume and which policy you implement, right? So one of the core applications is to stress test the model because probabilistic analysis is always fraught with these limitations, right? That you're only able to capture known risks in the model, whereas some of the bigger threats are currently unknown and waiting to happen sort of outside the model. So you need to stress test and gain additional insights from that. How robust, how resilient is your company to these shocks, these prolonged falls in revenue, if we take that as a proxy for a shock. So you want to have some buffers. That's referred to as risk capacity. You have a number of financial resources like extra cash, you have some spare capacity because of a strong balance sheet, and you have put some hedges in place that kick in when you really need the liquidity. And so those things would increase risk capacity, your resilience to these revenue shocks. And so they support risk taking, basically. They absorb some of these cash flow shortfalls that you might experience in some of the scenarios. So this framework gives you a way to very systematically analyze these things and find a level of risk capacity that is suitable and adequate for balancing your sort of commercial risk. So that is very that's very much the focus here in risk budgeting. We are going to explore and learn from stress testing. So it is a very effective tool then for the management of downside risk. You get all the insights you would need to carry out and undertake a solid due diligence of your downside risk, of your risk profile. And but the real point is, of course, to keep the upside intact. That's what we're trying to do here. We're not obsessing about downside risk for the sake of it. We're interested in upside, in executing the strategies and going where we think the value is. But there's a process for that, and that has to be able to operate, do its thing. And there are various threats to that value creation process. And risk budgeting is about managing that risk and avoiding some of those disruptions. So thereby allowing the strategy to be optimally executed. So that's upside. That's ultimately what we want. All right, so summing up, risk budgeting is about managing the risk of the enterprise as a whole, as opposed to these more narrow silo takes on risk management. A key point is to use it to illustrate how strategic decision-making drives the risk profile of the firm. And we want to learn how robust or resilient we are to shocks in revenue, these revenue shortfalls that occasionally happen. You know, how well are we going to deal with that? Do we have the financial resources to cope? So we therefore incorporate systematically ideas related to risk capacity, which is the idea of a buffer that supports risk-taking by absorbing losses and cash flow shortfall. So that would be risk budgeting. Please learn more about this in my books, and there's more information on riskbudgeting.se. And as they say here, please like and subscribe, and have a good day.